Watch this downward trend trace a perfect line, touch the exact tip of a lower wick within a fraction of a pip, and immediately launch upward. As traders, executing an entry with this level of pinpoint accuracy is the ultimate goal. Yet, most of us end up taking standard trades with wide stop losses, suffering through deep drawdowns and settling for mediocre returns. You can close that margin of error. By applying a step-by-step process called zone refinement, you can double your profit potential on the exact same market moves you are already trying to capture. To see how this works, open your preferred charting software right now. Select any asset you like, and set your time frame to the 4-hour view. Catching the absolute bottom of a reversal is a deliberate process. We are going to systematically hunt for hidden institutional footprints, large buying and selling orders concealed on the lower time frames. So, step 1 is establishing our base. Scan your 4-hour chart and locate a major price impulse, a sudden, massive upward or downward trend in the market. Look closely at the origin of that impulse. We are looking for the last consolidation candle. This is the single sideways moving candle resting immediately before that massive breakout occurred. Draw a box encompassing the entire body and both wicks of this specific sideways candle. Extend it horizontally to create your foundational zone. Plotting a standard long position tool against this wide 4-hour zone gives an acceptable trade, risking 1% to make 3%. This wide box represents a general discount area. It indicates the broad price range where large institutions previously placed significant buy orders. Taking a trade here is perfectly valid. However, that large margin of error at the bottom of the box means you are wasting potential profit. Instead, we definitely need to refine the setup. Step 2 involves looking inside the data of the 4-hour candle you just boxed by dropping your time frame. We follow a strict rule called the 2 steps down rule. You must only drop down a maximum of 2 standard time increments. From a 4-hour chart, you move to the 1-hour, and at most, the 30-minute view. Warning tone: do not skip directly from the 4-hour chart down to a 5-minute chart to hunt for even tighter margins. Over-refinement is dangerous. This animation shows exactly what happens when you go too far. You create a target zone so microscopic that the market price reverses early, entirely misses your entry order, and rallies without you. Zooming in correctly separates your order from the noise and increases precision. Zooming in too far ensures perfectly missed opportunities. Step 3 is analyzing the new data. Switch to your 1-hour chart, but keep your focus strictly inside the boundaries of your original 4-hour box. Looking at this zoomed-in 1-hour sequence, we now see the multiple individual candles that make up the original large box. Inside, we can highlight 2 smaller, distinct consolidation footprints. You are immediately faced with a critical decision. You have 2 smaller zones inside the original boundary, and you have to choose which one will trigger your limit order. Finding multiple zones is exactly what we want. This is the filtering mechanism that lets us isolate the true reversal point from the surrounding market clutter. To solve the dilemma of multiple zones, we introduce the concept of the extreme zone. We define the extreme zone as the area furthest from the current market price. Removing the upper option leaves this absolute lowest point. Place your set and forget limit order here. Notice how tightly the stop-loss boundary snaps directly underneath this extreme zone. You can trade that higher, closer zone, but doing so safely requires actively watching the chart to confirm the lower timeframe structure changes its trend direction. If you want a passive entry with the lowest risk, the extreme zone provides a highly targeted safety net that maximizes your potential upside. When the market pulls back, price dips down perfectly to tap the wick of our extreme zone. The order triggers with pinpoint accuracy, and the market immediately rallies toward the target. Look at this side-by-side comparison. On the left, the original unrefined 4-hour zone yields a standard 3% return. On the right, our refined extreme zone captures a 5.58% return on the exact same price movement. You generated nearly double the profit potential without relying on the market to move a single pip higher. All it took was a few calculated clicks to refine your entry point. Open your charts right now. Scroll back into your trading history and test this 2 steps down sequence on 5 different structural setups.
Nailing a precise entry is just one component of a successful strategy. Click the link in the description to access a free systems building course and learn how to turn these isolated techniques into a fully structured trading plan.